Hey guys, welcome back to the channel, and in today's video, since we're heading into 2023, I thought that now would be a better time than ever to walk you through my personal finances and give you a high-level overview of how I budget my salary as a private equity analyst. I'll be going through things such as why I'm already paying off my student loan in its entirety, what my cost of living is, and how I plan on investing any spare money that I have at the end of each month. If that sounds interesting, keep watching, and please like, subscribe, and hit the bell button so that you get notified whenever I post so that you can keep seeing more interesting videos from myself. Let's get straight into the juiciest piece of information, my salary. Now, full disclaimer, I'm not going to reveal my exact actual salary because that is confidential both to myself and the company that I work for. However, what I'm going to do is use a report from Arkesden that reports the various salaries for Analyst 1s and Analyst 2s at various investment banks, and hopefully from that you'll be able to get a picture of broadly what my salary might look like. So midway through this year, I'll hopefully be promoted from an Analyst 1 to an Analyst 2, i.e. a first year analyst to a second year analyst, and so should receive a pay rise. So what I'm going to do for the purposes of this video is take the highest Analyst 1 salary or the lowest Analyst 2 salary from this Arkesden report, which is about £65,000. Remember, this £65,000 is before tax and national insurance. So what I actually receive in my bank account is significantly less than this. In reality, what I get is closer to about £46,000 a year, which works out to about £3,800 a month. And so that's the top line that we're going to use for the rest of this video. Also worth noting that I pay 3% of my pre-tax income towards my pension, and so that's going to skew the figures a little bit here and there. What that means in reality is about £150 is reduced from this £3,800 top line as, let's say, a pension contribution. So that knocks my salary down to £3,650. Also, keep in mind that this is just using my base salary and doesn't take into account any additional compensation I might earn through something like a bonus. Alright, the next thing I'm going to talk about is a student loan repayment because it's quite controversial and it's quite misunderstood. In fact, I often debate a lot with other people about whether it's a good idea to pay off my student loan early or not. In most circumstances, it's actually recommended that you just pay off the minimum that you have to towards your student loan every single month. And this is especially the case if you're not expected to come out of university with a high-paying job. That's because in the UK, your student loans are written off after 30 years, and additionally, you only have to pay 9% of whatever you earn above £28,000. So for example, if I earned £30,000, then the difference between £28,000 and £30,000 is £2,000, and 9% of £2,000 is £180. So across a year, I'd only have to be paying £180 in student loan repayments. And so across 30 years, if you keep earning £30,000, let's say, then you're gonna get nowhere near towards paying your full £50,000 student loan repayment. So in a lot of cases, it doesn't make sense to pay off the student loan. Or rather, it doesn't make sense to pay off your student loan early or pay more money than the government requires as a minimum. However, this isn't the case for people who enter high-paying jobs straight out of university and who expect their salaries to grow quite significantly. For example, for myself, I'd be paying 9% of the difference between £65,000 and £28,000, which is roughly £3,000 across the year. At the same time, interest rates on student loans are very, very high. They currently sit at about 6.5%. So on a £50,000 student loan debt balance, let's say, which is very normal after 3 or 4 years of going to university, I'd be paying 6.5% on £50,000, which again is roughly about £3,000. So this year, if I had a student loan balance of £50,000, all the loan repayments that I would be making would basically be going just towards paying interest and wouldn't actually eat away at this £50,000 debt balance. Because of this, I actually stand to pay a significant amount more than just my initial student loan balance. I used the money that I gathered from my internship and any odd part-time jobs that I did whilst working at university towards paying off my student loan balance. So right now it only sits at around £28,000. Even with this reduced student debt balance of £28,000, I'm projected to spend £43,000 in paying back my student loan plus interest across the next 10 years. If anyone wants a copy of the Excel that I use to make these calculations, just message me either on LinkedIn or my email and I can send that to you. So for the remaining £28,000 student debt balance, I've thankfully managed to come to an arrangement with my parents. Effectively, they've given me a £28,000 loan, which I'm going to use to repay my student debt. and they're basically going to charge me interest at the same rate what student finance was charging me, but this way at least the interest stays within the family rather than me having to pay interest to some random company. So on a £28,000 loan balance at 6.5% interest, I can expect to pay £1,480 over the next year, which works out to be £140 a month. So the next thing, and probably my biggest expense that I have no choice but to pay, is my rent. Now I've spoken about this before, but the rent in London is crazy expensive. Right now on a monthly basis, I'm paying over £1,000 a month on rent. However, I'm paying such a premium for my location. I live in central London and only 10 minutes a bike ride away from my office, which is very useful as an analyst given that I might be working quite late in the evenings or into the night, and so I'd like to minimize my journey time to and from the office if possible. Fortunately, bills, despite the cost of living crisis that we're currently facing, isn't too bad. We get electricity vouchers from the government to help support us, and thankfully, because myself and my roommates aren't really in the flat too often, we don't spend too much on gas and heating either. Probably about £20 a person a month. Water is also pretty cheap, probably about £15 a month, and then Wi-Fi is about £10 or £11 a month, so not too expensive. So the overall utility bill works out to be between £45 and £50. We'll take the £50 as a conservative estimate for this video. Because most days I'm able to get breakfast and dinner for free at work, the only real meals that I need to worry about are my lunchtime meals and my weekend meals. Those often work out to be about £9 to £10 a meal, so roughly £70 a week in just lunchtime meals. The other meals that I need to deal with, so my breakfast and dinner meals on the weekends, I'm normally able to cover using about £20 worth of grocery shopping every week. So my total weekly expense food is about £90, and that works out to be £360 a month, which I know isn't amazing in terms of being frugal, but as I've mentioned before, it means buying out or eating out does save me a lot of time that I can use towards doing things like creating this video. So after all these fixed and variable expenses, I'm projected to have about £1,700 a month left. And so if I don't touch this amount and just dumped it into a savings account every single month without any additional spending, I'd be left with about 20,000 additional pounds in my bank account at the end of the year. Of course, there'll be random bits of discretionary spending on things like going out for dinners with friends or on other experiences, so my overall cash balance will be less than what I've projected. On this remaining £1,700 a month, I don't intend on just chucking that into a savings account. I want to invest that money and make that money work for me. I think that my perspective towards investing is pretty different to most people's. I found that most people's view or idea of investing is just chucking their money into an S&P 500 index fund and watch or hope that their money grows at anywhere between 5 and 7% a year. Now that's all well and good, and I definitely will be spending some of that money towards investing into index funds. However, I think the bulk of that remaining £1,700 is either going to go towards savings or investing into my own passion projects, side ventures and side hustles. And here's why. Namely, while the returns are a lot less guaranteed than investing into an index fund, the return on investment potential, if any one of my said projects goes well, is a lot higher. I stand to make a lot more money if just one of these projects goes well. For example, I plan on investing money into my YouTube channel by paying for editors, so hopefully I can get more videos out to you guys on a more regular basis. Hopefully by doing that, I'll be able to grow the channel at a faster rate and get monetized sooner. Similarly, I plan on spending a bit more money on developing the wider ASURE business. That is my business where I offer successful CVs, cover letters, and personal statements for sale, as well as offering a team of consultants who can help walk you through the university application process and help guide you into getting into prestigious and competitive industries such as medicine and finance. If that sounds interesting and you want to find out more, please click the link in the description below. The other thing that I have against investing into index funds is that the personal finance YouTubers who often promote them make it sound as if you're guaranteed to make a positive return every single year, and that really isn't the case. For example, on the money that I haven't spent on paying down my student loan balance, I've spent a lot of it investing into these index funds, and I'm currently down 20% on on my initial positions. And again, these index funds aren't meant to be particularly risky, but maybe I bought them at a bad time. But the point I'm trying to make is that you're not guaranteed to make a positive return on index funds. So that's why, while I will be investing in index funds, I think I have more conviction in my own ability to grow these side ventures and these other businesses than what I think the return on investment fund might be able to provide me. Finally, the only other notable thing that I'll be investing into on a monthly basis, if you want to call it an investment, is into my Help to Buy ISA. Now, the Help to Buy ISA is the precursor to what is now a lifetime ISA, but to give the gist of what it does, it basically is a government scheme that is meant for first-time buyers. The government will provide a 25% bonus on the money that I deposit in there when I finally come towards buying my first home. Now, of course, I don't plan on spending the full £1,700 either. Every single month, I want to give myself a bit of a buffer so that I can start building up an emergency fund, a rainy day fund, just in case something bad happens in the future. And I think that's advisable for most people. Anyway guys, that brings me to the end of this video. If you did like it, please remember to like, subscribe and share the video to anyone else who you think might find the video useful. And let me down in the comments section down below what else you'd like to see. Thanks again guys, and see you soon.